Right at the top of this edition of India Tonight, let's talk about our inflation scenario. Retail inflation has eased. It's eased to 6.83% in the month of August. And this is from that 15-month high of 7.44% in the month of July. That was what the records show. The August print slightly below expectations, but still it remains above, in fact, way above the RBI's 6% limit. So food inflation has clocked in just under 10%. Core inflation, on the other hand, stands at 4.8%. In July, it was 4.9%. On the other hand, you have industrial output, which has grown by 5.7% in July, according to the government data that has been released. Let's understand the impact that inflation has on the markets. But first, let's tell you what happened on the last read today. We've seen the Nifty start the day off with fresh record highs, but then it fell sharply at the start of the session as well. It managed to recoup some of those losses eventually, ending the day flat. A majority of the counters declining in trade today. BPCL and NTPC were the top laggards, and both the mid caps and the small caps have closed the day in red territory. The Sensex also closing flat, marginally in the green. Sectorally, we've seen the IT sector emerge as the top gainer, led by stocks like Infosys and TCS. And the IT stocks were followed by the pharma pack among the gainers. Then you had realty stocks and metal stocks. They ended the day in the red. And this means that they have cooled off from the previous rally we've seen in those particular sectors. Also, auto stocks entered the slow lane in trade on the back of that diesel tax row. But let's get a deeper understanding of trade as it panned out today. And for that, my colleague Anisha Jain is joining us. Anisha, if you can walk us through today's trading action and the movers and shakers in trade.
Well, it was a day of profit booking. So after that 20,000 level that we hit yesterday, the all-time high, the market started well in the green. But during the trading session, there was a sharp profit booking that happened across the board. Of course, it was a lot more exaggerated in the mid-cap and the small-cap space, because at one point of time, the small-cap index was down as much as 4%. But by the end of the trading session, we recovered a bit, even if not recovered, maybe stabilized, because 20,000 is something that we managed to hold on to. In terms of the sectors, it was defenses that were doing all right. Case in point being IT. That was your top sectoral gainer. TCS was up a good 3%. There was some news flow and reports talking about some fresh order bookings that are likely to come from US. So that supported sentiment. But other than that, Infosys too was holding up comfortably in the green. And the next pocket, which was in green, was pharma. So Divi's, Dr. Reddy's, Lupin, these were the names that we were tracking. On the losing side, real estate stocks were seeing profit booking, right from Indiabulls Real Estate to a Prestige to an Oberoi Realty. And then metals and even PSU banks, for that matter, were on the back foot. Autos were very volatile in the trading session on account of reports that there could be 10% additional duty coming in for diesel engines. So very flip-flop happening throughout the trading session on account of that. But overall, railway names, defense names, they saw massive profit booking in the trading session today. But overall, the experts believe that it's just a bit of consolidation, not a reversal right now. So let's see how it plays out.
Some consolidation right now in the markets, but of course inflation is going to have its role to play in market conditions going ahead, and these are among the several moving pieces because there are several global cues. And remember, global growth is not at its strongest. India, like many are indicating, is standing out as a beacon, but how much can it hold out? Let's find out. Madhavi Arora is the lead economist at Emkay Global. She's joining us along with independent market expert Mahantesh Sabarad. Great to have you both this evening. Madhavi, coming to you first, looking at the latest CPI data, what's your sense of the RBI's action on interest rates so far and the kind of impact we are seeing of controlling the rise in prices?
So clearly, see, RBI has limited role to play as far as food inflation management is concerned. Clearly, the kind of food shock that we saw, which was led by perishable, has largely reversed. I mean, you're seeing tomato prices, which had seen the highs of 200% month-on-month increase in the month of July, has started to contract very sharply. And September month will see further contraction to the extent that you'll probably see it going back to the, pre-shock levels. But we're also seeing onion prices now sort of ticking up, in the month so far. And you are seeing some divergence in the way vegetable prices are behaving. But nonetheless, I think overall the perishables are looking to be sort of getting in a control zone. I think it's a non-perishable inflation which is getting a little persistent, which is basically cereal inflation, pulses, spices, which have been up since early part of this year. And if you track the current production of pulses as well, the current Kharif harvest season is likely to be lower this year. And we also are seeing the lower area sown so far and lack of adequate rain for this particular monsoon dependent crop, that is pulses. So I think to that extent, RBI's role is relatively limited in terms of food shock management. All they can do is probably continue to sound a little cautious with regard to any kind of penetration of food inflation that gets into general inflation at this point in time. But I think currently, what my understanding is that you will see a very sharp reversal in perishable inflation. Non-perishable will remain a little bit sticky. Core inflation, even though will look sticky for the next quarter or so, should likely ease as we get into the next calendar year, because we are expecting domestic demand to ease, especially towards the latter half of the year. I think all of that should imply that your overall inflation should be somewhere close to a 5.3, 5.4% on an average. Of course, we'll have to see a lot of other variables that how they play out. And that sort of, again, gels well with RBI's current forecast for the year. And to that extent, I think RBI should at best just stay cautious and not do any kind of policy action, at least in the immediate run.
So in terms of the kind of realm that we are, in terms of inflation, it still remains above the RBI's comfort level, but we are seeing it decline as far as those concerns on the food front are concerned. Mahantesh, the markets have seen the bulls unleash their strength, at least this September. It has been a broad-based rally as well, and some experts are suggesting caution, especially in the broader markets, and the uptrend that we've seen over there. Now, with this kind of inflation trend, do you think the bulls could retreat, considering that oil is like looming heavily as far as the horizon is concerned? How do you think that's going to play out?
So firstly, the commodity prices and the corresponding inflation does affect the market, but the effect, I consider it as fairly temporary. What is more important is the overall profit outlook for the various companies, particularly on the Nifty 50 side. The outlook has been such that with growing capex and slightly better demand growth coming in, we should be seeing upgrades in EPS, which we have seen. The entire calendar year so far has seen mostly upgrades in EPS relative to the downgrades. And I expect that irrespective of the inflation trend ahead, we should be seeing further upgrades coming in the market. But that doesn't necessarily mean the valuation will continue to remain elevated. It is elevated as of now since the markets are hitting new high. But I do consider that inflation will be a temporary phenomenon, and therefore the sentiment will not prevail too long in terms of the bears prevailing over the bulls.
Madhavi, do you agree? Because on the interest rate front, the rise that we are seeing in oil prices, that's something the RBI would need to be a little more than cautious about. The Fed is, of course, going to announce its decision this month. But what are the factors that will come into play as far as oil prices are concerned and the resultant impact on the Indian economy?
So again, the oil supply at this point in time looks to be quite tight. So I think oil prices could remain rangy, in the coming months or so. But just to note, the FITD so far, oil prices have averaged close to around $80 per barrel, and RBI's own estimate has taken around 85. Even our own forecast have taken an average of around 85 dollar per barrel average forecast of Brent. So there is some scope for us to absorb the kind of pain that we might see in the coming months or so. But I think overall, Brent should remain close to around 85 to 90 average, and that I think is something that as an economy we can still endure, given that other levers are looking fine. As regards Fed, again, I think we are of the view that Fed is largely done. We are not expecting Fed to really raise rate in the upcoming policy, which obviously will help emerging central banks to probably get back to their own drawing board and see their own inflation trajectory and their demand trajectory, and then take a call on their own reaction function. So I think RBI will also get some kind of leeway on that front. But that said, clearly crude remains a risk for India because we import 80% plus of our crude demand and thus to that extent it feeds into all our economic variables, be it inflation, be it fiscal, be it even the growth forecast for that matter. So if Brent suppose goes to 100 and stays there, that will be a big worry for me. At 90, I think we can at this point absorb the pain. If it sustains beyond a quarter, it'll be something that we'll have to rework on. But I think at this point, assuming that a 90 is a new average that you see, I think you will still somewhere be averaging close to 85ish, 86 for the year as a whole, which I think is okay for us at this point in time.
86 would be okay. Mahantesh, what are the risks in these market conditions right now? Because global cues, like I started out by saying, growth is not the strongest globally. Now, India's growth, you're looking at the industrial production numbers for India too right now. How promising do they seem? Will they hold out? Because in terms of domestic sentiment among investors, we saw the SIPs that have really remained consistently strong in the recent past, and that's the case last month as well, in July, in August. Now, tell us if this is going to sustain or not. Is this the time? Because the kind of run-up we've seen in the broader markets, many are suggesting that we should be cautious at this point in time rather than experience some kind of FOMO. Which camp do you belong to?
So I do expect that the market will kind of cool off for a while. It doesn't mean that I'm talking about it falling. Simply because we've had good industrial production growth so far, which you alluded to, and I expect a little hiccup ahead, but then we should be seeing that through in the next 6 odd months to an accelerated pace of industrial production. The only worry that I see on the horizon is the deficit monsoon we have had thus far. We are about 10% odd deficient in terms of the monsoon progress so far. But we have seen lately that monsoons very often, trail off, or the progress of the monsoon is well into October. That makes up for a lot of at least water deficit, if not the overall crop yield. But then what I'm essentially sensing is that barring a few months of a little hiccup in terms of demand related to monsoon deficiency, we should see accelerated pace of industrial production happening probably in the next calendar year, and that should help boost the overall earnings of the companies. As it is, the rally you would have noticed is much broad-based, and it has come largely from the domestic push rather than the FII push. We did see a large amount of FII flows come in May, June, July, not much really in August, and we are probably seeing September a bit of an outflow. So that said, the domestic push in terms of investments and the much later revival in the industrial production should keep the outlook and sentiments a little positive. And therefore, we will probably see a flattish kind of market, not necessarily a dip.
Madhavi, CapEx cycle needs to be robust, both on private and public. Where do you think that stands right now? And do you see an upside? Because to sustain this kind of economic activity, especially in sectors like power, etc., you need that CapEx to keep flowing in. In light of global growth concerns, do you think our own demand is going to really help in adding capacities with added CapEx? Where do things stand on that count?
So, if you see the last 3 years, there has been obviously a, improvement in the capital expenditure of the government of India. And there's been also some traction on private sector capex, especially given the fact that most of the companies are sitting with much cleaner balance sheets. And also the sense of deglobalization that you're seeing is also requiring companies to, invest into new technologies. And, they're also finding opportunities with regard to capacity expansion and the extended demand that the world will probably see. But that said, if I really look at the numbers, because we get the data of private sector capex with the lag when it comes to both listed and non-listed companies from the government of India, but we can still get a proxy of it on a quarterly basis if we look at the GFCF number or gross fixed capital formation numbers on a quarterly basis in GDP and adjust that with government and state spending on capital formation. We get some sense of the corporate sector traction, which I think on a smoothened basis hasn't really picked up substantially. There's been some pickup that we're seeing from the large cap guys, but I think on the um, especially the unlisted and household segment, which again is a very important component of private sector capex, which we tend to neglect in terms of numbers, and we are unable to track it also on a sequential basis. I think is one segment which is still pretty weak. So, private sector capex, I don't think has really picked up to the extent that it could look sustainable. For me, it generally consumption and investment tend to go hand in hand if you really want them to be sustaining for the medium term. My sense is that consumption in India will likely slow. Last 2 years hasn't seen any, robust demand from rural side, and urban was the only segment in consumption which was growing to a large extent. And I think as we get into this year, you will see falling income growth in the urban sector as well, and you will see some kind of a pressure on corporate sector profitability as well, which I think will probably lead to some caution as far as the corporates are concerned, especially when the noises around global slowdown slash recession really picks up probably by the end of the year or early next year. So we'll have
Yes.
to see how
Yeah.
strong the capex story this time around
Exactly.
is.
So earning season is going to be, of course, an important one to watch out for. How much of that sustenance is there in the kind of good results that we've seen, at least in the last quarter. And now to look at the quarters ahead with the slowing global growth story, we'll have to see how much of an impact that has in our own corporates. But of course, there are several moving pieces, like we said, inflation being one of them. And for the moment, it does seem like we are on a declining trend, and the RBI perhaps is not going to make any sudden strong moves to be able to control price rises at this point in time, is what Madhavi has indicated. And Mahantesh, many thanks for joining us as well with your perspective on these market conditions. Meanwhile,